Okay, so getting to today's topic. Sorry, guys. If you had a chance to look at the book, you will notice that today's chapter, so the chapter, I think this is, remember, I think it's chapter 5, I'm not super sure, should be chapter 5, but the chapter of the book on sell-side M&A is probably the only chapter of the book that has no formulas, no Excel reference, no printout from a table or anything, okay? So this is going to be a very discursive and descriptive and maybe boring lesson. I don't know if you're bored or not of this type of things. This is a very procedural lecture, okay? So what we need to do is to go through the process that a company and an investment bank can use to set up what is called a sell-side mergers and acquisition. Okay? Now, since the A in M&A stands for acquisition, the concept of a sell-side acquisition sounds a bit weird. So what is it? A sell-side deal is an M&A where the process is started by the sell side, so by the company who wants to be sold. Okay? I'm the CEO of a company, and I want this company to be bought by somebody else. Okay? So the process is started by the sell side. There are multiple reasons for this. In the story of the week, I gave you 3 articles from the Financial Times on a sell-side deal initiated by GSK, GlaxoSmithKline, that is a pharmaceutical company who is refocusing on oral care and over-the-counter medications, and so is selling a division that is doing other stuff, for example. Or another typical example would be, this is a bit different, but 20th Century Fox. If you remember, last year, 20th Century Fox was bought by Disney, bringing the X-Men back into the Marvel universe, if you care about the stuff, but maybe we will get a good X-Men movie down the line. They had to write off $200 million of losses because the last X-Men was crap, so that's kind of important for Disney. So the company was bought by Disney, but it was a sell-side initiated deal. So Rupert Murdoch said, we are no longer big enough to compete in the world of entertainment, of movie productions. Now we have these new players like Netflix and Amazon that have deeper pockets that we have, so we can't invest enough money in the production of movies and content and platforms, etc. So it's better that we sell to a bigger player. And so the Rupert Murdoch conglomerate, I don't remember if it's News Corp, who was the owner, they decided to sell 20th Century Fox, in that case, to Disney. If you remember, there was another competitor. I don't remember who was that, if Comcast or somebody else. But that was, again, a sell-side initiated deal. Next week, we're going to look at buy-side deals that are the more traditional ones, the one initiated by the buyer. And then maybe you have heard more because there are these hostile deals that are very fun to look at, etc., when you go and try to buy a company, etc. So today, sell side. As usual, I prepared yesterday a concept map. I'm really trying to use this to help you to navigate the book because it's a bit logoroic at times. It talks too much, and there is too much details, and you can get lost a little bit in the weeds. So the idea is the following. So we start from the concept of a sell-side M&A. We start from the M&A, and then first of all, we're going to look at different mechanisms. Okay? There are, broadly speaking, 2 mechanisms, 2 or 3, according to how you define them. You can sell through a broad auction, a targeted auction, or a targeted sale. Okay? And the difference basically is that with a broad auction, you announce to the market, I want to sell this division, or I want to sell this company. Who wants to buy? And you ask buyers to come and give you an offer. So it's very broad. You cast a wide net and you look for possible buyers. At the other extreme, there is a targeted sale, where you say, look, I want to sell this division, and reasonably enough, there is only one buyer that makes sense. I'm going to directly call that CEO and tell them, look, do you want to buy us? Can you still read? I don't want to waste time with the lights the whole lecture, because apparently they want to stay up. Targeted auction is like in the middle. It's an auction, so there are multiple bidders, but a small number of them, like 2 or 3 bidders. Okay? Sorry, guys, I would really appreciate if you make an effort to stay quiet, because otherwise I need to scream, and it's very annoying for everybody. And after describing these 3 methodologies, we are going to look that there is a fundamental trade-off. And the trade-off is, if you have a broad auction, so lots of people bidding, you are more likely to get a higher price, because there is a competition, 10 people want to buy the company, so it's easier to get a higher price. And if you want to sell for the highest possible price. On the other side, the broad auction is very expensive to run. And so sometimes there is a trade-off. You say, OK, I'm willing to accept the risk of missing on the higher price, but I want a faster, cheaper, and safer mechanism. So you go targeted auction or targeted sale. OK. The sale process is relatively straightforward for the auction. That is the mechanism that we are going to look at. Usually, these are organized as 2-round auctions. So basically, there is a preparation phase where the investment bank and the company work on setting up the auction. And then there are 2 rounds of bids. First round of bidding, 20 people, 20 companies bid. You look at them. You say, OK, these 8 make no sense. Thank you very much for your effort. The 12 will proceed to a second round of bid. And then you will weed out the number to 2 or 3 preferred bids that you like, and you will negotiate individually with them to see if you can squeeze some more dollars or some better term, etc. And then there is the closing once you have chosen the best bidder. OK. We will also look at some key documents that will come through the process. We will not spend time here describing them, but they will come through. So keep them in mind, because these are key concepts. So the confidential information memorandum, that basically is the way the company provides prospective bidders with confidential information on the company so they can choose the right price. This is subjected to a confidentiality agreement. That is very important. We are going to see it. The only way you can get, I can give you confidential information on my company is for you to give me a confidentiality agreement. So basically, you accept that you're not going to divulge or spread this information around. And then we are going to see the stapled financial package that makes no sense until we see it in context. So it's a key concept. Keep it there, but we are going to describe it later. OK, so in all of these, there is still a point that the book doesn't invest a lot, so it's good that we keep it in mind, because it's all spread out through the chapter. This is an investment banking subject, so where is the investment banking here? Because this is a sell-side process, so it's a company, they want to sell, so 20th Century Fox, they call business, they call Disney, do you want to buy us? Yes, that's the price. OK, so where is the bank? Huh? The role of the investment bank is an advisor to the seller. And what's the advice on? Well, for example, choosing the best process. Should we do an auction? No, look, for you, there is a natural buyer. The only buyer that makes sense is this company, so let's call them directly so we save time and money. Or, no, look, don't do a targeted sale. Do a broad auction, because you have a very wide market appeal, so there may be people outside that we don't know of, so let's go broad. So advise on the process. Then help to find the possible buyers. We haven't seen this. Some time ago, a few years ago, I used to do in the first lecture a small case study on an investment bank that specialized in Silicon Valley. And this investment bank, the main is a small outfit. It's called Catalyst. And their main skill is that, say, we know everybody in the Silicon Valley. So if you want to sell your company, come to us because we can tell you who is the best buyer. Because we know all of them. We know who has cash. We know who's willing to buy, who's willing to diversify, who's willing to acquire that specific type of assets. So the idea of helping to find a buyer is very important, find possible buyers. Most importantly, they need to advise the seller on what is a reasonable price that they can expect. Huh? I get a bid for somebody says, I'm willing to pay for your company $1 billion. Is that enough? Is that good? Am I worth more or less? So the investment bank can help that. And then the investment bank will prepare the staple financial package. We're going to see later what that is. And finally, in some specific situations, so when the company that is selling is a public company, the investment bank has to provide a fairness opinion. And this is a legal requirement in the US. I don't know if there is the same thing in Australia, probably. And the idea is that basically there has to be an official document that says, look, this price that has been offered makes sense. Dear shareholders, you are not being ripped off. Okay? Okay, so this is the concept map. Now we are going to go through every single step. As I said, the book is a bit logoroic, so there is a lot of stuff. So sometimes I'm going to skip. But as I say, there is no formula, no table, no nothing. It's just plain describing process, etc. Okay, this is basically we are going to see an introduction to the three, to auctions and negotiated sales, etc. And then we are going to quickly through the process. Okay, I've already expressed this. This is basically now. What is an auction? I think that is a sufficiently well recognized English term. You have all, I don't know if you participated in an auction, but you have seen them. You know about art auctions, where there is the guy with the hammer, and they're selling a painting, and people raise the the flag, $1 million, gentleman over there, anybody 1.1, 1.1 over there, blah blah blah, etc. So that's a auction. Now auctions are very complicated, and there is a lot of variety. The one that you see in the art houses for selling painting is an increase in auctions. There are, funnily enough, auctions where the price goes down. There are auctions where you publicly bid. There are auctions where, like in this case, where the bids are confidential and they come into an envelope. Okay? So one thing is the auction for the paintings, where all the buyers are in the room and people bid, and you see, that guy really wants the painting, so I'm going to stay out. Or 1 million, 1.10, okay, I can do 1.2. A sealed bid auctions, like we are doing here, is different. It means that you only have one shot. You put your best price in an envelope, you give it to me. If you are too low, you're out. Okay? Now, as we said, the biggest advantage of selling through a public auction is that you can be sure that the person who is willing to pay more is going to get the company. Okay? In a sense, the idea is, as a CEO of a company, more or less, you know that your company is worth $1 billion. But, first of all, you still can hope that there is a moron out there that is willing to pay 1.5. Okay? You know that you are not worth 1.5, but if he wants to pay, you say, okay, fair enough. Okay? So that's the hope. But also, the value of the company depends on who the buyer is. Remember that last time we said LBOs is pure financial buyer, so there is no strategic integrations. But here, there is strategic integration. So some buyers can make you worth more money. I said the stupid example of 20th Century Fox and Disney. But think about it. The biggest franchise that 20th Century Fox had at this point are the X-Men. And the X-Men are clearly worth more as a franchise if you put them inside the Marvel Cinematic Universe. Because you can tie them in with the Avengers, you can do lots of stuff, okay? Rather than if Sony or Comcast or somebody else buys that same franchise, they can't do that. So that thing, that specific asset, the franchise, the X-Men license, is worth more to Disney than to anybody else. So Disney may be willing to pay more, okay? So that's also why you want a broad auction, because you want people, you want the best buyer to come forward, okay? Now, what is the drawback? So why don't we do super open auctions? Because they are very expensive to run, okay? And apart from that, just the raw cost, and we are going to see later all the bureaucratic steps, and you will see that there is a lot of costs. But there is also some interesting things. For example, information leakage. We are going to see that at a certain point in the process, you are going to provide confidential information to all the possible bidders, because they need to know really how much you're worth. And so you will need to provide access to internal information on your strategy, your assets, your risk, whatever. Stuff that is not public. So for example, if you're a pharmaceutical company and you are developing a new drug, even if it's very secret, if you go up for a sale, the buyers need to know how is the drug, what are the test results? Is this a revolutionary drug? Is it working? Is it not? This is confidential information. Now, it's true they are going to sign a confidentiality agreement, but it's also true that the more bidders there are, the highest is the likelihood that there is information leakage, so that information will get out. So that's a risk. Employee morale. Again, sometimes it's not, especially for startups, small companies where you have some very key employees, etc. If you sell, there is a lot of uncertainty. Will I keep my job? What happens to my stock options? Will the new boss like me, etc.? So that can create a negative impact internally. So usually you want to sell as quickly as possible. Possible collusion among bidders. We're going to see later. This is a problem. Imagine that your company has two divisions. You know, pet food in South America and pet food in North America. Okay? And you want to sell your company. You may have two bidders that they are really pushing the price up because they are bidding against each other, or these two bidders can simply collude. And bidder one can say, look, I don't really care about South America, I only care about North America. And bidder B says, well, I'm the opposite, I only care about South America and not North America, so why don't we offer a low price and then we split it among us? So they can collude and they can create problems for you. Okay. Taint in the event of a failed auction, that's very fun, but it's very true. There is nothing worse than going out and says, hey, I want to sell myself. Any buyers? Anyone? So that's devastating. If you have a very public auction and then you can't close it because nobody's offering you enough money, that's devastating for the company. Okay. And then we said the cost. And so we said, look, if you are not willing to put up with all the needs, all the cost, all the risk, etc., you may want to either try to negotiate directly with a small number of buyers, doing a targeted auctions. Basically, you try to reduce the cost and the risk by reducing the openness of the process, with the trade-off that maybe there is somebody out there that was willing to pay more, but you don't know about that and doesn't come forward. Okay, so broad auction. The term broad means you maximize the universe of prospective buyers. Again, we already said that. Okay, and the trade-off, the cost is that you need a bigger organization to run it. and we're going to see later why. Target auction instead is, look, let's call this 5 people and that's it. Okay, small number of buyers, easier to maintain confidentiality of information, but then of course there may be an additional guy out there that was willing to pay more and you don't know about. Okay, this is not particularly complicated. Negotiated sale instead, or negotiated transaction, or negotiated trade, we said is the opposite, is the idea where you just call somebody and say, hey, look, you are the only reasonable buyer for my company, so I'm going to sell to you. Now, this is a very old deal, so I don't remember. I don't think that happens like this, but when Google bought YouTube, that was the typical thing that for YouTube there was a natural buyer. Because YouTube had content, but no advertising technology. Google had advertising technology and not content. So that was a match made in heaven. It made plenty of sense. So if I was YouTube, again, I don't remember what they did at the time, but that would be the typical case where a negotiated sale makes a lot of sense. Interestingly enough, in many negotiated sales, the banker plays a critical role as the idea generator. Okay? In your assignment, you're doing a pitch book for the buyer. So in your assignment, you're working on a buy-side acquisition. But you may have the same, roughly the same work done as a sales-side pitch, where you prepare a presentation and you go to a company and say, hey, look, you are too small to compete in this market. So the best thing that you can do to create value for your shareholders is to sell now. And I would suggest that we contact this other company. I know that they are interested in expanding in South America, or they are interested in expanding in your lane of business. Just let's talk to them. So the investment bank can do the pitch originally. Okay, and then it says it's faster. You don't need to market it because you go to the guy, you call them, and you just set up the deal. If they are willing, that's it. Okay, so this slide is a bit complicated. It's a table that is in the book, but I think that is intellectually, if you spend 1 minute to think about it, makes a lot of sense. So the idea is, up to this point, we have done 4 lectures basically on valuation. And we have seen comparative companies analysis, comparative transaction, or as the book called them, precedent transactions, discounted cash flow, and then LBO valuation. Okay? Now, the valuation for an M&A, for a sell-side M&A, is based on all these, and plus adds some additional component. So what the book is telling you here, look, every type of valuation is based on some common factors. Okay, so for example, company performance, growth of the company, market share, economic outlook. So these are factors that drive every single valuation model to a certain extent. But then it says, when it comes to the specific valuation model, each one of them has some very specific drivers. For example, CCA look at specific peer companies, free cash, discounted cash flow, a specific driver is the cost of capital, etc. For leverage buyout, for example, a specific driver is the credit market conditions, how easy is to find financing at a lower interest rate, etc. When it comes to sell-side M&A, all the previous models can be used to find a reasonable price, but there is some additional characteristics. For example, the process dynamics, the buyer appetite. Okay, how much appetite there is for companies of my type? How much appetite there is for artificial intelligence companies now? I'm a young startup. I cannot raise any more capital. I need to sell. How much appetite there is for startups that do facial recognition now, no, etc. So there are unique drivers that can drive the price of an M&A deal beyond the simple valuation models. Okay, So I think this is intellectually very important. Why was this transaction executed at such a high price? It's not justified by peer or by CCA. It's not justified by cash flows. It's not even justified by leverage buyout valuation. So why there is such a high price? Well, for example, competitive dynamics. There was a broad auctions, and there are two main players, and they were trying to outbid each other because none of them wanted the other guy to buy the company, for example. So you're lucky, and you get a very high price, not justified by DCF or anything else, just because of the competitive dynamic. So I think this is an interesting slide to keep in mind that the price for the sale may not be justified by the valuation model because there are other specific factors. Okay, we already said it's a two-round bidding process. And then we are going to see the different steps now. Okay, this table just collects all the information on the different steps. We are going to see them individually, so I'm not going to comment this. Just interesting to have a look at the time scale. Preparation, 2 to 4 weeks. So from when the CEO calls the investment bank, it may take a month to just get prepared. Okay? Then the first round, 4 to 6 weeks. Basically, we collect the first bids. Then the second round, 6 to 8 weeks, so longer, because at this point there is a reduced number of bidders, but they have more information to look at. Then we take 2 to 6 weeks on average to negotiate with 2 or 3 guys that we really like, and then the closing is kind of open, and we will see later the closing. There is all the legal stuff, regulatory approvals, the government has to approve maybe, all these kinds of things. Okay, so here I would say, apart from the laundry list of what happens in every phase, just keep in mind the time scale. Okay, so step number 1, organization and preparation. I repeat, this is the phase that starts from when the CEO decides, I want to sell my company. And maybe, let's say, when the CEO calls the investment bank, the advisor. Okay? There are 5 things that happen here. So let's go one by one. So the first thing is the investment bank should help the seller to really understand what they want. This sounds a bit glib, so I apologize for that. It seems that the bank knows more. But basically, the idea is, for example, for the bank to understand, why do you want to sell? How urgent it is? Do you want to maximize the price, or do you want to maximize the speed? What are you looking for? Okay? And all these priorities will determine, for example, how many prospective buyers will we approach. So basically, here we need to generally understand, do we want to go very quick? So let's just talk to these 2 or 3 guys. Or do we have time and we just want to get the highest price, so we go broad? Okay? Okay, at this point, the other most important thing is, this is the stage where the investment bank has to help the management to get a rough idea of what price you can expect. Because remember, the management may not have idea. Now, here really we need to understand that there is a difference between when the sell-side company, when the company is public or private. If the company is public and the share price is $10, well, that kind of is a guideline. You should expect more than 10, of course, but basically we just need to understand how much more than 10. But if it's a private company, a company that is not listed on the market, like a startup, etc., then the valuation is fundamental because the CEO may have no clue how valuable the company is. Okay? Here there is a thing that we saw a couple of weeks ago. If you remember, when we do DCF, discounted cash flow, we have multiple scenarios: base, upside, downside, optimistic, pessimistic. And then we said there can be something called a management case. And the management case is exactly what happens here. Because usually the management, they are smart enough, the CFO is smart enough to do a DCF, and so the CFO will present the banks and look, this is our management assumption, this is our financial model. We think that we are worth $1 billion. Why? Well, because look at the DCF, and the role of the investment bank is to see whether the assumptions of the management make sense, whether that model is solid, there are errors, say, look, 10% expected growth rate of sales, no way, forget about that, nobody will ever buy that, etc. So basically deal with this situation. Now we need to get to the famous staple financial package. I don't remember if there, no, let me just introduce it. There must be a slide later, but it's in the book. One of the things that we will see later is that every buyer will have to provide an explanation of how they are going to pay. Okay? So a buyer can say, look, I'm willing to pay $1 billion for this company, and by the way, I have more than $1 billion of cash, so I'm going to pay in cash. Another buyer may say, look, I only have half a billion dollars in cash. For the other $500 million, I'm going to get a bank loan. And by the way, here there is the letter from the bank that they are willing to give me the loan. Okay? So every buyer has to provide a financing solution. The idea is, as a seller, I want to be sure that when I choose a buyer, the guy actually has the money to buy. Okay? To be double sure, the advisor of the seller, so the investment bank that is working with the seller, usually will prepare a stapled financial package. And the idea of the stapled financial package is a baseline, a minimum financing solution that the investment bank is willing to offer to whoever wins the bid. Okay? So, for example, the investment bank will say, we think that this company is worth $1 billion, and we are willing to offer $500 million of loan at these conditions, with this interest rate, etc., to whoever is the winner. Okay, so the staple financial package is a baseline financing solution prepared by the advisor of the seller. Why do we need this? Because this will help the seller, because you know that whoever wins the auction, at least they can access debt financing. They may find better terms outside, that's all for them, but at the minimum, they can access this financing so they can actually buy the company. Okay. Slide here on that. Then we select the buyer universe. Here there is, a lots of blah, blah, blah. It's not particularly relevant. It's telling you that sometimes you choose a specific investment bank as an advisor because they have contacts in Silicon Valley, or they have contacts from other pharmaceutical companies, etc. In a broad auction, usually you want both strategic buyers and financial sponsors. So among the buyers that you will contact, there will also be some private equity firm that is not looking to integrate with you, but maybe they can willing to pay more for some reason, etc. Okay, again, it's not rocket science. I think we can move on. Okay, so at this point, we start with the idea of we have decided to do a broad auction, and we have compiled a list of 20 firms, 20 possible entities that we want to contact. Okay? Now, the next step is to prepare the marketing material, because you need to sell something, so you need to market it. Okay? How do we do it? Well, there are two main documents that we are going to present now. The most important one is the confidential information memorandum. And then we have the teaser. What are they? Well, the teaser is a two-pager, usually. It's a two-page document, it's a PDF, 2 pages, where basically you put some very basic information about the company. Nothing confidential. This is all public. This is all public. Okay? And basically, it's just to say, look, this is a company in this industry, with this organization, historical growth of sales in the last 10 years, whatever, this is our financial statement, so just the super basics. And this is basically what you send to the companies when you contact them for the first time. So you call them, we are going to see in a second, there is a call, you call them and say, hey, look, I'm the Goldman Sachs, I'm representing this company, they are willing to sell, we are going to, if you agree, we are going to send you a 2-page document just to give you some idea, etc., then we can talk later. So this is the teaser, okay? Now, a more substantial document, 50 pages or more, is the confidential information memorandum that instead is a super detailed explanation of what the company is, how the company works, full of confidential information, okay? I will send the teaser immediately to the buyers. I will not, here there is a laundry list of possible topics, in industry overview, history of the company, strategy, the product, operations overview, manufacturing, distribution, how the company works, all the financial informations, etc., etc., etc. But it can contain some substantial amount of confidential information. Like, for example, my manufacturing plans, some information on them that is not public. So there is stuff here that is confidential. So, and the confidential information memorandum, I will only send it after they sign a so-called confidentiality agreement. What is a confidentiality agreement? We're going to see it later, actually, in three slides. But basically, it's a document where the prospective buyer, they say, OK, I understand that you are going to send me this confidential information memorandum. I understand that this is confidential, so I'm not going to send it to anybody, basically. Okay, we are going to see this later. We have finished the preparation. We have chosen the broad auction, chosen the list of the 20 buyers, possible buyers, prepare the teaser, prepare the confidential information memorandum, prepare the confidentiality agreement. Okay, so all the documents are ready to go. Now, what happens? So how does it work? So now, okay, in the first round, all of these things happen. There are lots of steps, but the most important thing is that starts when we call the buyers and finishes when we receive the bids from the buyers. Okay, so basically, the first round is we call them, then some stuff happens in the middle, and then we receive the bids. Okay, with the laundry list for this stage. So as you can see, 1, 2, 3 is stuff that we do. Okay, we call, we get the confidentiality agreement, we send the confidential memorandum, and then the buyers start working on that. And now we need to wait, because we gave to every buyer like 6 weeks or 4 weeks to do the bid. In the meantime, what do we do? In the meantime, the seller and the investment banker keep working on other stuff. Like what? So, contact the prospective buyers. You don't care this, even if you get a job in an investment bank, it will be years before you do this, because this is the role of the partner, of the big guys. You're the guy in the back using Excel, but the big guy will make a scripted phone call where you talk to the CEO, blah, blah, blah. And then they are really obsessed in recording and keeping every track of everything. I don't know why, but it's for legal reasons. I think that the problem is that they want to show that the auction was fair and that they were not advantaging anybody. That's another story. Okay. When we do the first phone call, we send the teaser, 2 pages, and the confidentiality agreement. Now, the confidentiality agreement has a lot of stuff inside. So let me give you, some of them makes perfectly sense, like use of information. Okay? So the problem is, what can you do with all the information that you will receive because of this auction, like the confidential information memorandum? And basically says, look, you can't send it to anybody, you can't use it for other purposes, etc. Okay, term says, okay, this agreement is in force for 6 months, whatever. Permitted disclosures, for example. Permitted disclosures means I'm going to send you the confidential information memorandum. You can't show it to anybody, except it's well known that you will have to show it, for example, to your investment banker. And you will have to show it to your lawyers, to your accounting firm. So there are some permitted disclosures that are detailed. Okay, return of confidential information. This is all PDFs now, so technically you should cancel the PDFs from your servers. I don't know if people actually do it, but you should do it. Okay, then we have the fun stuff that people usually don't think about. So no solicitation, no hire. What does it mean? Well, imagine that I'm a small pharmaceutical company. I want to sell my company. So I call the buyers, and I give them information on the company. And the key information is that I have this genius researcher who is in charge of developing this revolutionary drug for, I don't know, diabetes. Okay? A prospective buyer could say, look, instead of paying $500 million for this company, I can just give $3 million to the guy and hire the key researcher. Okay? So in the confidentiality agreement, for example, there is a clause that says that you cannot hire anybody from my company for the next 3 months or 6 months or whatever. Okay? Stupid, but is important. Okay? When you show who are the key members of your team, for example. One other thing is that you could hire my accountant to get inside information. Or you could give my CFO telling him, look, if you push the price low, after the acquisition, I'm going to hire you and give you a bonus. So, there are all these type of deals that you shouldn't do. Standstill agreement, it means for the whole time of the auction, you will not try to buy shares in the company. This is very important because let's assume that there is a broad auction, and I understand that lots of other people are competing. What I may try to do is to front run them and make this a buy-side option, a buy-side M&A, and start buying stocks in the company based on the confidential information. Again, standstill clause, you can't do that. You cannot buy stocks for the whole period of the auction because you have access to confidential information. Okay, restriction on clubbing means that different buyers cannot sit down together and collude for any reason. Okay, so this is a bit original, but this is... So once every buyer sends me back the confidentiality agreement signed by the CEO, at that point, that buyer will receive the confidential memorandum. Okay? Some buyers can receive the teaser and say, look, thank you, but no thank you. We don't have money or we don't care. That's it. If they want, they sign the confidentiality agreement, send it back. They get the confidential memorandum. At this point, every buyer will engage their own investment bank, their own advisors, and basically they start preparing their bids. Okay, so they start finding out how much they are willing to pay for my company. Okay, together with the confidential information memorandum, usually there is also another document that is not particularly super important, but is good to know, the so-called initial bid procedure letter. Basically, the confidential memorandum has all the information on the company. The letter specifies what's going to happen now. So, look, you have until this day at 5 p.m. to send your offer. And by the way, if it says 5 p.m., it's 5 p.m. I'm saying this to the one of you who told me, I thought that the assignment was, that the quiz was due at midnight. No, it was due at 5 p.m., it means 5 p.m. So just pointing that out, it was written 5 p.m. Last year, I put 12 noon, and like 6 people thought that that was 5 p.m., to midnight. So this time to avoid, I said 5 p.m., it's clearly not midnight. End of business day is not end of day. No, so that's another story. Okay, sorry, that's when you get old, you get cranky. The letter also specifies what the bid should contain. Okay, so the bid should not be, you know, a coffee place napkin with written $1 billion signed by the CEO. Okay, should be a bigger document and should have the price, should have where are you going to get the money, should get what's going to happen to the management and the employee, usually especially the management, thank you. What's your timing? Is there any condition that you want to be respected? You know, regulatory approvals. You know, maybe the buyer is a regulated company, like is a military company, so they need approval by the Ministry of Defense, or there is some antitrust regulation, so we need approval by the government, etc. And then, okay, the phone number. So these are basically the letter specifies the shape of your offer. Your bid should have all this information. Okay, again, particularly relevant. Okay, so this is what happened. We contact them. So let me go back for a second to the slide. Well, for example, we are going to see that in the second round, we are going to do presentations. And so that has to be prepared. Prepare the presentations. Then there will be, in the second round, a key thing called the data room. Now, data room is a 20th century terminology, is a pre-internet terminology. Data room used to be a secure physical location, usually in a basement, with armed guard at the entrance, full of the internal documents of the company, books, accounting numbers, all kinds of super secret information. And so it needed to be prepared physically so that in the second round people could come in. Now it's all electronic, so it's a secure Dropbox. It's better than Dropbox, but it's a secure Dropbox. But that's basically has to be prepared now. So we prepare the presentation, prepare the data room, and then prepare the financial package. Okay? So again, the staple financial package is a baseline financing solution that the advisor of the seller prepares and is willing to give to whoever wins the bid. Okay? Says provide comfort, the necessary financing will be available. Again, the last thing that you want is that you choose a buyer and then the guy doesn't have money, so you want to be safe. Okay. Now, finally, so remember, telephone calls, confidentiality, we send a memorandum. They start working on their bids. We start working on the remaining documents that we need to prepare. Then we start receiving the bids. Okay? Okay, here as an effective sell-side advisor is able to discern what is real, what is not. So you need, okay, there are competitive dynamics here. Usually you get 20 bids, or you contact 20 people, you get 15 bids, and you need to be able more or less to have a look at them and decide what makes sense, what doesn't make sense. You can call them to seek clarification. Sorry, in your bid you say that you want to retain the existing management. Exactly what does it mean to retain? Are we going to get a bonus? Or, I mean, all these type of things, etc. And then we make a decision out of these 15 bids, who's going to advance to the second round. Okay? So, second round. Again, we contact 20 people. 15 will send the bids. Out of these 15, we throw away 5 because they make no sense at all, and we are left with 10. This 10 will advance to the second round. The second round, what does it mean? Well, basically, the second round centers on facilitating the prospective buyers their due diligence. Here, the key word is due diligence. You are buying a company, you're going to pay $1 billion, you want to be sure what you're buying. You want to be sure that there are no skeletons in the closet, that we are not selling because, you know, there is a lawsuit against us that could cost $10 billion. Okay? Okay, you may have seen yesterday Johnson & Johnson was condemned by a jury, by a judge in Oklahoma to pay $600 million because they sold opioids, drugs that created problems. That is one lawsuit that they have out of 1,000, because basically every state and every county in the US is suing them. Purdue Pharma has basically declared bankruptcy, or is going to declare bankruptcy. So all these pharmaceutical companies, for example, you want to know, I'm buying a pharmaceutical company, is there any lawsuit pending? Is there any legal trouble on the horizon? So you need to do your due diligence, okay? Okay, so the process here is management presentations. I'm not going to spend time on this. The management will present the company. Campus visits. This makes sense for some companies, not for others. If you're buying a small startup, you want to see it. If you're buying a tech company, you want to see the labs, you know, et cetera, et cetera. And then, most important, provide data room access. At this point, you open the data room to these 10 bidders. And again, if it was physical, you would have a data room for every buyer because you don't want to know them to know each other, etc. Now that is all electronic, that's not a problem. Okay, allow me to skip on these things. You know, okay, management presentation. Usually the CEO is there, the CFO is there. They try to look good, etc. Okay, site visits. Again, not particularly difficult. Data room. Again, the key problem is I want, for the guy to be able to make a proper offer, the company, the buyer needs to know everything about me, and so I need to provide access to this information. And then, of course, I will also give them a letter, again, with all the procedure for the second bids. Same thing as before. With the additional that this is the last bid, and so they need to commit to make it binding and open up to a certain point. Okay? You don't want somebody to give you a bid, then you choose them, they say, ah, sorry, no, we changed our mind. Okay? Okay. Final bid. And then, you know, hopefully, what you would like to get is something like this. Is an agreement that usually the second bid is much more final than the first. And so it should almost be in the form of something that you say, okay, I like it, I sign it, it's a go. Okay, so something ready to be signed. Okay, final bid. Should not have any conditionality. Again, should be final, should be fixed, they should commit to it. We have already seen this. Okay, so at this point, we receive 10 bids. Remember, we started with 20, 15 send us a first round bid, we cut them out, 5, we get 10. Out of these 10, now, we are going to look at them, and we are going to choose few of them. How many? Well, the thing is, you never want to choose only one, because then you're stuck with that person, with that company. And if they know that they are the only one running, they may try to, you know, lower the price or put tougher conditions, etc. So you want to keep a little bit of competition, but you also want to focus your energies to something that is really good. And so usually what you're going to do is to choose 2 or 3, something like that. Okay? At this point, the idea is to basically decide whether we like the price or not. So at the end of the story, it's kind of all about the price. And then we are also trying to find out how binding is, how committed they are. Are they seeking for an out? Are they leaving door opens? You know, these type of things. But you know, I would say let's focus on the price. Okay. Just to be clear, legally, in this type of bids, there is no duty to be fair to anybody. Okay? So, in theory, even if I do an auction, I don't need to be fair. I'm looking for the best bid. Now, here says the advisor seeks to maintain a level of playing field, so not to advantage one bid on another, etc., etc. This is more for reputational reasons. Legally, there is no binding constraint here. Okay? Okay. Select the winning bidder. Negotiate a final definition. So we are going to work out the last details. This is very important. Seller normally reserves the right to reject any and all bids. So up to the end, we can always say, sorry, nobody offered us a price that we consider reasonable. We are not going to sell. It's very bad. It's very damaging as a reputation because it means that nobody values you the way that you are basically, that nobody cares about you, nobody thinks that you are worth what you think you are worth, etc. But it can still be done. Okay. Now, at this point, we need to go into the closing. So far, the only actors that we have spoken about are the CEO, so the management of the two companies, and the advisors of the two companies. Now, question. On the seller side, at the end, we have 3 preferred buyers. We negotiate with them. Let's assume that we get one bid that we really like. Who has to make the final decision to sell the company? Who is the final decision maker? For a public company, let's say listed on the stock market, who is the final decision maker? Shareholders, because the shareholders own the company. So remember that up to this point, we never spoke about them. This is all the CEO that decides that they want to sell the company. But at the end, the owner of the company is not the CEO, it's the shareholders. So the shareholders have to approve. Now, sometimes, in the case of 20th Century Fox and Disney, the CEO is called Lachlan Murdoch, and the owner is called Rupert Murdoch, and so they are basically the same thing. So basically, in that case, the decision was already made by the main shareholders to sell the company. But at the end, legally, you always need to approval of the shareholders. And if the company is listed on the stock market, you have a lot of small shareholders. You don't have one large, big shareholder. Because if you have one large, big shareholder, that shareholder nominates the CEO, so he has perfect control to a certain extent. But if you have multiple shareholders listed on the stock market, so thousands and thousands of small shareholders, they will have to approve. Now, to be clear, if Sydney Airport wanted to do a sell-side deal, immediately, just before start, they will, since they have one large shareholder, that is UniSuper, my superannuation fund, that has 20% of the shares. I mean, informally, they will talk to the guys there, say, look, we are thinking about doing this. Do you agree with that? Because if your larger shareholder doesn't want it, you don't even start. But nonetheless, at the end, you still need approval by your shareholders. Now, what is the risk for a small shareholder? The risk for a small shareholder is that the company is really worth $1 billion. But the CEO will accept an offer for $500 million and will receive a payback in his Cayman Island account of $200 million. Okay, so that's the risk. So the shareholders need assurance that the offer is fair. And this is called a fairness opinion. Now, the fairness opinion is not a valuation of the company, doesn't have a DCF, doesn't have anything. It's just a letter from an investment bank that could be a separate team of the same investment bank or a completely different investment bank that says this offer is fair. It means this offer makes sense. It's not saying this is the best offer. It's not saying this is a good offer. This offer financially makes sense. It's not a ripoff. May not be the best one, but it's not a ripoff. Okay? So this is the fairness opinion. Then, before we get to the shareholders' approval, of course, you need approval of the board of directors. So I said the CEO formally is the CEO with the board of directors. They say, okay, we choose this offer. Usually what happens is that the CEO will choose the offer, show it to the board of directors approve. At that point, we do the announcement. Okay? Public announcement. Disney will buy 20th Century Fox for this price. Okay? At that point, closing conditions. Okay? And closing conditions require regulatory and shareholders approval. Okay, so let's go to this. I repeat, don't get confused. Physically, the CEO chooses this offer. The board of directors approves it, say, yeah, okay, let's go ahead with this. There is a public announcement. At this point, before you can actually close the deal, you need to satisfy other conditions. Among them, you may need approvals from governments and regulators and approval from your shareholders. Okay, so regulatory approvals, some of them are very specific, industry specific, like military companies, strategic companies. Now in America they are thinking to putting something special for artificial intelligence companies. They don't want the Chinese to buy companies in the US. So you all can, these things of national security. Okay, now let's put those apart because I'm not an expert. The big regulation approval that we usually talk about is antitrust. Okay? If Kohl's was to buy Woolworths, we would end up paying broccoli $50 a kilo. Why? Because they would have monopoly on broccolis. Since nobody can live without broccolis, they can raise the price as much as they want. Okay? So you want to avoid that type of thing. So in every country, usually, there is some sort of regulation approval of this stage. You may remember in the US, there have been a couple of AT&T and Sprint, a couple of big telephonic mergers that needed approval. In Australia, the Competition and Consumer Act of 2010 prohibits mergers and acquisitions that would substantially lessen competition in any market. There is an authority called the Australian Competition and Consumer Commission. Usually what happens is that the two CEOs will seek an informal approval, and then they go forward with the deal if they get the informal approval. Okay? Formally, what happens is that after they announce, the regulation authority could stop them. So I don't think that there is a formal approval. They get an informal approval, and then they don't get stopped. But I'm not a legal expert. So if you've done a law subject and it's different, believe them. But the idea is we get some sort of regulatory approval, sometimes explicit, sometimes implicit. And finally, shareholders' approval. Finally, we need approval of the shareholders. Okay, bit of complication. There are two strategies that you can use to get a shareholder approval. One step and two step. Okay. One step is the normal one. We announce the mergers, we announce the acquisition, and the CEO of the seller will call for a shareholders meeting. Okay? Formal shareholder meeting, you need 50% plus one vote. And that's why usually if you have a large shareholder, you will informally seek their approval before you start, because otherwise there is no way you're going to get there. Okay? And so the time can be 6 weeks, sometimes even up to months, depends on the, how complicated it is. Okay, let's forget about the SEC because we are not in America, but basically in every country, once you call the special shareholder meeting, you need to send to every shareholder the documentation so they can, including the fairness opinion, so they can decide that that's a good deal, is value creating for them, is not a rip-off, and they are going to approve. So this is the standard one. You announce, you call for a shareholders meeting, shareholders come in, they vote, you get the approval, you go ahead. Now, there is a two-step process that can be faster. And the idea is the following. you announce the idea of the acquisition, but instead of calling the meeting, the way you execute the acquisition is that the buyer, let's assume that the buyer has decided that they are going to buy us for $1 billion. And $1 billion is equal to $10 a share. Okay? What the buyer will do after the announcement is to open a tender offer. Basically, to publicly tell to the shareholders of the seller, look, I, company A, and the CEO of your company have agreed on this acquisition. It's a joint statement. And so now I am going to offer $10 for every share that you want to give me. So basically, what you do, you go directly to the shareholders and say, look, this is the offer, it's $10 a share, come forward if you want to give it to me in the next 2 weeks. Okay? And so we do the acquisition in this way. Instead of going to the shareholders meeting to get their approval, I just say, look, $10 a share. You want? Give me your stocks. And so you buy the shares automatically. Now, the tender offer is conditional on sufficient acceptances. So, of course, the offer is structured so that I give you 3 weeks or 2 weeks. If in these 2 weeks I get at least 50% of the shares, we go ahead. If I don't, everything dies. It means that there is no approval. Now, what is the trick here? The trick is I'm going to try to get 90% of the shares. Because if I get at least 90% of the shares, I can do what is called a back-end short-form merger. That basically means I can do the merger without calling the shareholders meeting. The last 10% of guys, they are roped in. They can't complain. Okay? If 90% of the shareholders approve by selling the shares, the other 10%, I don't care about them. They are just going to be roped into the acquisitions, either if they want or not. Does this make sense? Now, what happens if I get 55% of the shares? So enough to get over the 50%, but not the 90%. I cannot do this back-end deal. What I need to do at that point is to call the shareholders meeting that, by the way, I'm sure of winning because I have more than 50% of the shares. Okay, so here the idea is that, why do we do this? The idea is that calling a shareholders meeting is a pain in the neck. And so you need, because you need to give 6 weeks of notice, and a public location is very expensive, thousands of shareholders coming, to complain, blah, blah, blah. The other one, the two-step, is faster because I just open 2 weeks, give me your shares, done. Okay? So it's faster. So that's why you want to do it. Now, the book now goes into the weed in this slide and say, look, it's faster really only in 2 situations. One, when we pay cash. If I have cash and I pay cash, I can do the two-step. It's very fast, $10 a pop, give me your shares, this is the cash out. Okay? Very quickly. Now, sometimes, we're going to see it better next week, but sometimes when I do a deal, instead of paying in cash, I pay in stocks. And I say, for every stock of your company, I'm going to give you 1 stock of my company. Or, for every 2 stocks of your company, I'm going to give you 1 stock of my company. This type of things. If this is the method of payment, if the transaction is not in cash, but is based on stock, then the two-step doesn't work because it's a bit technical, but the buyer will have to create the new stocks, create the new shares, and that takes 6 weeks anyway, because legally you need to do a lot of stuff with the SEC, or with the ASICs, etc., and so there is no time advantage. Same thing. If you need a big regulatory approval, that is going to take 6 weeks anyway, or 2 months anyway, so there is no advantage in doing the two-step model. So if it's a thing that you can do fast because it's cash and there is no regulation approval, two-step is usually the faster. Otherwise, you go 1 step. Okay, then financing and closing, that's pretty easy. Here, the only interesting terminology that I think you really should remember, because it comes out. So the buyer will have to raise the capital, and usually they already have agreements. So they issue the bond, they issue the new stocks, they get the loan from the bank, all these type of things, and then we close. Sometimes there is a terminology that is called bridge financing. And bridge financing basically means I need to pay cash. I need $500 million. I'm organizing to issue a bond for $500 million. It's going to take 3 weeks or 4 weeks. But I want to close the deal now, so my investment bank will give me a short-term bridge financing of $500 million. So bridge financing is a very important terminology. It's usually a very short-term loan, like 1 week, 2 weeks, that the investment bank gives to a company to execute a deal before the regular financing comes through via bonds, stocks, whatever. Okay, that's it. As I say, lots of terminology, lots of process, but I mean, it's a bit mnemonic. I apologize, but it's very interesting to, to see the process. Okay. Now, before we leave, story of the week is a very interesting deal that went down last year. So basically, GlaxoSmithKline has a division called Horlicks that I don't know anything about, because 95% of their business used to be in India. That basically is like, is not cocoa powder, the malt powder. How do you call it in Australia? Sorry? Yeah, but there is a name, the green package. Milo, yeah, that awful stuff. Once when I came 8 years ago, I thought it was hot chocolate. It was, it's almost like similar reaction to Vegemite. It's an acquired taste. We also have it in Italy, but I never liked it as a kid. So that's their product, okay? Basically, that's what they do. Now, let's read a couple of, sorry guys, let's read a couple of lines from the article. This is the article from September 19, and the title is Nestlé, Unilever, and Coca-Cola bid for this unit. And says, some of the world's bigger consumer companies have submitted non-binding bids for GlaxoSmithKline. Okay? So this is probably, if I had to guess, this would be the first round of a targeted auction. So few big bidders sending non-binding offers, so sounds to me like a first round of a targeted auction. GSK is expected to produce shortlist in the next 2 weeks. Okay, so bidders include, okay, so very interesting. Nestlé, Unilever, and Coca-Cola, all of them are industrial companies that work in similar businesses. So these are strategic buyers, plus a consortium led by KKR. KKR is a private equity firm, so this is a financial sponsor. Okay, so you have both industrial and financial buyers. Why is this company going up for sale? The Emma Walmsley, the CEO of GSK, says, blah, 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 the company was launching a strategic review of this division to support the funding of $13 billion acquisition of Novartis stake. So they need cash to buy another company, and so they are selling this division. Okay? And that says, it's a terrific brand, blah, blah, blah. However, given that we are focusing on over-the-counter and oral health, we need to sell nutritional divisions. Okay? Typical deal. Bids are expected in this range, 2.5 to 3 billion. Okay, so this is September. Okay, September. Then we jump ahead to November 28. GlaxoSmithKline has entered into exclusive negotiation with Unilever. So that means that at that point we finished the second round, and we have entered into, we chose one offer, and we went into negotiation with that. Okay? The Anglo-Dutch consumer company beat a rival bid from Nestlé, blah, blah, blah. where it already sells Milo and Nesquik, so you see, it's a competitor. Coca-Cola was also shortlisted. I don't know how matches with Coca-Cola, sounds disgusting, but maybe they were trying to expand in non-carbonated drinks. For the auction that opened in September, blah, blah, blah. Unilever offer price could not be determined, so it's still confidential. But, okay, for $2 billion, blah, blah, blah. Okay, so basically it says the company is listed on the stock market. So the value of the company is 4.2, but GlaxoSmithKline only holds 72.5% of the shares, and so this is worth $3 billion. So the idea is, this is a listed company, and it's worth the 72% of the shares that Glaxo has is worth $3 billion. So that's the low level. It means you can't offer less than $3 billion because no shareholders will give you the shares if you offer a price lower than the stock price in the market.